Friends, one small mistake in your accounting policy can force you to restate your entire financial statements. Yes, the entire thing. That is exactly what IND AS 8 prevents. Let us understand this completely today.
Welcome, dear learners. Today we are looking at IND AS 8. This standard prevents massive restatement disasters. It gives us a very clear framework. We will cover its three main pillars. These are accounting policies, accounting estimates, and prior period errors.
First is objective and scope, on-screen relevance and reliability. Our goal here is enhancing relevance and reliability. This standard prescribes criteria for selecting and changing these elements. It ensures financial statements remain perfectly comparable and reliable.
Let us look at the first pillar. Accounting policy. Yes, accounting policy. These are specific principles, bases, conventions, rules, and practices an entity applies these in preparing and presenting financial statements. Think of them as the rules of your own kitchen. You must use the same cooking method every time.
Next, what is a change in accounting estimate? It is an adjustment of the carrying amount. This applies to an asset or a liability. It results from assessing present status and expected future benefits. This comes from new information or new developments. Therefore, it is definitely not a correction of an error. Our third pillar covers prior period errors. These are omissions from and misstatements in financial statements. They happen for one or more prior periods. They arise from a failure to use reliable information or from the misuse of reliable information. Errors include mathematical mistakes, oversights, misinterpretations, or fraud. This is like fixing a wrong entry in your old account book.
Section 2 is selecting and changing policies. Consistency is absolutely key here, friends. You must apply policies consistently for similar transactions. Unless an IND AS specifically permits categorization, do not change them.
But what if no specific standard applies? Management must follow an exact hierarchy. It is a step-by-step, logical approach. First, check requirements in IND AS dealing with similar issues. Second, look at conceptual framework definitions and criteria. Third, consider pronouncements of the International Accounting Standards Board.
Now, changing an accounting policy is highly restricted. An entity shall change a policy only under strict conditions. First, it is required by an IND AS. Second, it results in reliable and more relevant information. Remember, early application of a standard does not count as a voluntary change.
When you change a policy, you use retrospective application. This means applying a new policy to transactions and events. You apply it as if that policy had always been applied. You must adjust the opening balance of affected equity. You must also adjust comparative amounts for each prior period.
There are impracticability exceptions to this backward application. Sometimes the effects of application are not determinable. Sometimes it requires assumptions about management intent, or it requires significant unobservable estimates. If we cannot determine these cumulative effects, we stop. We then apply the new policy prospectively.
So, the key takeaway here, friends, is this. Policies are the foundation. Change them rarely and apply them backward.
Now we move to Section 3, Changes in Accounting Estimates, Embracing New Information. Business uncertainties mean items cannot be measured with perfect precision, but reasonable estimates do not undermine reliability.
Where might we need estimates? The standard gives exact examples. Estimates are required for bad debts and inventory obsolescence. We need them for fair value of financial assets and liabilities. We also estimate useful lives of depreciable assets and warranty obligations. A revision is needed when circumstances change, or when we gain more experience. How do we apply a change in estimate? We use prospective application. We recognize the effect in current and future periods. Think of it this way. From today, the recipe changes, old dishes stay as were. It affects only current and future profit or loss.
So the key takeaway here, friends, is this. Estimates look to the future, adjust them today and tomorrow, but never yesterday.
Section 4 covers correcting prior period errors. This is all about fixing the past. Current period errors are usually fixed before approval, but material prior period errors are sometimes discovered later.
We correct these using retrospective restatement. This corrects recognition, measurement, and disclosure of amounts. It corrects them as if a prior period error had never occurred. We restate comparative amounts in the very first financials after discovery. Or we restate opening balances of assets, liabilities, and equity.
Listen carefully to this rule, dear learners. Hindsight should not be used when correcting amounts for a prior period. The source gives a very specific example. Imagine calculating an accumulated sick leave liability. You must ignore next period's unusually severe influenza season. You only use information available when statements were approved.
So, the key takeaway here, friends, is this. Errors must be erased from history as if they never happened.
Friends, this brings us to the big difference segment. This is the most commonly confused area. Let us settle this once and for all.
Let us compare retrospective versus prospective side by side. Retrospective applies backward. It adjusts opening equity and prior comparatives. Prospective applies forward. It adjusts only current and future profit or loss.
Let us view this matrix of the three pillars: policy, estimate, error. First, policy means specific rules or principles. We correct this using retrospective application. Second, estimate means an adjustment from new information. We correct this using prospective application. Third, error means misstatements or omissions. We correct this using retrospective restatement. Let us quickly recap everything we covered today. Policies equal retrospective application. Estimates equal prospective application. Errors equal retrospective restatement. Three pillars, friends: policies, estimates, errors. Now you know all three.
Friends, ask yourself, are your changes in estimates actually disguised errors? Knowing the difference is absolutely crucial. Friends, if this helped you, give it a big thumbs up. Share it with your CA friends, colleagues, and batchmates. And subscribe, because every week we are breaking down complex standards into simple, clear content just like this. See you in the next one. Thank you, friends.